We're about to kick off the Thursday edition of the Not Your Average Investor Show. We are live on Facebook for the rental income property of the week.
Week.
You like how I switched it up and came quick there? I am your host, Pablo Gonzalez. With me, as always, the guy they call GC because of his genius concepts, because he generates cash flow for people like myself, and because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you here on this Thursday. How is everybody doing out there? Thank you all for lighting up the chat there. It's wonderful to have the recurring faces that we have here and all the new faces. Thank you guys for being here.
It is indeed. It is indeed. And, you know, on a personal note, I went live on Facebook and talked about my newly acquired property. And I had a bunch of people from the JWB community, a bunch of fellow Not Your Average investors giving me congratulations. The more and more this is such a community, right? Like, I feel like this is my group of friends, and I just really want to acknowledge the support that I get on Facebook, the support I get in person. I think it's really, really cool. And yes, Lee, I was wearing a crown. It wasn't a real crown. That was a Facebook magic. But as you all know, we have recurring people here. You all know this is a completely interactive show. We want you participating. If you just want a basic guide to passive income, go to jwbpassiveguide.com. You get to download the spreadsheet that we're going to be tinkering around with all day today, and a couple of other really valuable nuggets that'll shed some light into the journey that I am officially now on, and so many of our other Not Your Average Investor Show community members are here. Greg, before we get into this property, man, let's talk about the stock market. What the hell is going on?
What the hell is going on in the stock market? You know, short squeezes are going on. We've got internet, Reddit chat rooms, you know, overpowering Wall Street. Like, what's going on here, man?
Yeah. Listen, what I like to say is, if there is a bunch of nerds in a chat room that are making hedge funds get scared, what is the average investor supposed to feel, right? Like, if they can have that kind of force, what is the average person supposed to feel? Which is why it makes me feel good that I'm not an average investor now, right? Like, that I am diversifying into other things that you can't just go on a whim so quickly. There is gatekeepers in the way that, you know, there's appraisers, there's politicians, right? Like,
yeah, I mean, you think about rental properties, and, you know, maybe one of the things that people say is a downside to investing in real estate would be the fact that it's illiquid. Right. It's not as easy to sell a piece of real estate as it would be to buy and sell a share of stock. You know, one of the reasons why it's illiquid is because there are so many things that have to go in a certain direction, right? So many hands in the pot of a real estate transaction, right? You know, you've got the buyer and the seller, right? But you also have the lender most of the time, right? The majority of people buy with financing. Well, you know, there's an appraiser who has to get on board, right? There's the title company. You have to make sure that the title, you know, and illiquidity would be sort of nice in the stock market when you're coming to the GameStop situation now, or wherever else there's market manipulation going on right now, because, you know, there's no appraiser for what GameStop's stock should be, right? And ultimately, there are a lot of people who are making a lot of money, and there are a lot of people that are losing a tremendous amount of money in the GameStop situation. Ultimately, you could be on either end of that, but I think we can all agree that that amount of volatility scares the hell out of people. And if you're somebody who has your money in the market right now, and you see what type of market manipulation can go on that you have no control over, where stock prices and your wealth ultimately are really not tied to fundamentals at all, that scares people, especially if you're counting on this type of income or wealth nearing retirement or nearing some big life event. So I really feel, I think people are motivated by fear and greed, and the fear of market manipulation has never been higher that I can remember as far as what it is right now. And I think what that does is it leads people to asset classes that are based on fundamentals, which of course is rental property investing. It leads people to a consistency. There's a real value in consistency. There's a return element of just being consistent and that doesn't show up in the dollars that you earn, but there's just real value for people to be consistent. And I think you're going to see a lot of money move out of the stock market because of what's really been uncovered and has gone on.
All right. You ready for this property, Gregg?
Let's roll, brother.
Let's put this thing on the screen. Today, we are looking at a property that generates $235 in estimated monthly cash flow, comes with a 2.4K rent credit to the buyer at close. That sounds attractive. And it's at 7047 Red Robin Drive, Jacksonville, Florida, 32210. And it's coming in at a beautiful looking 10.04% ROI. Total price point, $165,000. Gregg, the first thing that comes to mind when I look at this house is this thing's pretty, man. Like, I could live here.
Yeah, it does look like the sun's shining, you can tell the high quality of the renovation here. It's a beautiful looking house, right? I mean, yeah. But what do you think I'm going to say about that, Pablo?
You're probably going to play the contrarian and tell me that you're going to be the Rock and be like, it doesn't matter if it's a good looking house, right?
It doesn't matter. The first thing we got to look at is the return on investment, right? Because if we come back to last week when we were talking about the rental income property of the week, it didn't look like this. Week. It did not look like this. Yet I still told you this was an amazing rental property investment. And really, you got to train yourself to look at it that way. The last property that we looked at happened to be an example of the house not being completely renovated. And it was a real challenge for people to be able to look at something like that and to look at the numbers and say, you know what, this makes sense, get excited about it. And of course, that property is sold. So if there's one thing that I can continue to help all of our investors on the call continue to do is to look beyond the picture. I'm going to keep including it for you guys, but I'm going to still beat you up a little bit if we go to the picture first, because you shouldn't be investing with emotions. You shouldn't be investing based on the picture. Now, obviously there needs to be a high quality renovation or a high quality new build. And we can certainly talk about how to do that and how we do that at JWB. But I'm going to continue to challenge you all to look at numbers, even when you look at a really nice looking property like that.
Sounds good, Gregg. Let's look at the numbers then. So we're gonna go through these numbers. We're gonna break this down for y'all, but I want to encourage you to start putting in your questions right now. Anything that you have, rental property investing, this property investing, anything like that, we're gonna get them answered ASAP, because once one question starts, 100 questions start, right? So we want to dive right into it and serve you as well as possible. So Gregg, first thing first, the things that you're buying is the cash flow and the ROI. Estimated conventional financing total monthly cash flow, $235 per month. What does that mean? Is that $235 that goes straight into my bank account, or what are we talking about here?
Yeah. So two elements that I want you to look at whenever you're evaluating a rental income property of the week.
Week.
First thing is your monthly cash flow. So at the end of the day, we're investing for the income stream here, as well as the total return on investment, right? The income stream is really cool, right? If you invest in the stock market, generally you don't get that type of an income stream or any income stream at all. But in rental properties, we're able to invest in a rental property and rent it out for a whole lot more than the expenses that you're going to have every single month. And that's what you see at that $235 a month here for this house on Red Robin. Specifically, the way you generate that number is you look at the rental income coming in, and we're looking at the expenses that happen on a normal month. And that would be taking away your principal payments, your interest payments, your property taxes, your property insurance costs, and your monthly property management fees. Those expenses happen every single month. And so you take that rental income coming in, you subtract out all those expenses that I just listed, and every single month you're going to see $235 of a net amount when a normal month happens for this property on Red Robin.
All right. Well, I'm not purposely trying to be distracting here, but I'm fiddling around with a share. Maybe Josh Stanley can help me out here. He works for Zoom. Maybe he can tell me why I can't figure this out. I always forget to click that button that optimizes it for sharing later on. So, I don't want your face to be cut off, but now I just did it way worse. But now we know. So that is cash flow minus monthly regular expenses. And the What's the difference between that and the conventional financing total ROI that we have here of 10.04%?
So cash flow is what happens on a normal month for you. This is what you should expect on a normal month. But there are other things that are going to happen that aren't normal or that don't happen in a normal month. Some are going to be really positive. Some are going to be negative. So the total return on investment takes everything into account. It takes into account that net rental income, which is that $235, but it also takes into account all the other things that can happen. So specifically, in order to get that 10.04% return, you're going to take your profit centers of positive rental income, like we just talked about, positive cash flow, which is your rental income minus your expenses. And we're going to include additional expenses that happen every once in a while, like maintenance costs and vacancy cost, and the full brunt of your tenant placement fees. This is a common trick that other people may use to kind of bump up their returns, is they don't actually use real maintenance and vacancy numbers, and they definitely don't take the full brunt of the tenant placement fees into account. And ultimately, that's not under promising and over delivering, which is what we try to do. So we include all those expenses, which actually lowers your return. We're also looking at some other profit centers that you may not be thinking of, like tax savings. This is income tax savings, and you get a whole lot of tax advantages from rental property investing. And so we're looking at the tax savings that's coming from that. We're also looking at the amount of principal that has been paid down on your loan by your resident paying you rent every single month. And that's called principal paydown. And that's a real profit center as well. So we take those together, those profit centers together, and we divide it by your initial investment, which also includes your closing costs right off the bat. And that's how we generate that 10.04% return on investment.
There you go. I can't help but notice that there's something you're not mentioning there, but we're going to go into questions. As promised, we got some questions in the Q&A. We're going to get into them immediately, and later on, we'll do the trick of what happens here. So Chad Willis asks, when was the renovation completed?
So this home was actually moved in 2019. So the renovation was completed in 2019 on this home. And there's been our current resident in place since then, and they're signed up for a long-term lease. The lease is actually through 2022.
So current resident already in place. I guess that's a good time to talk about the approach to renewing leases and having a resident in place and keeping them there, right? Like if you already have it sounds like they have one more year, but you normally do 2-year leases. Why wouldn't you take that out and try to find somebody and put in a 2-year lease? And talk me through that.
Yeah, absolutely. And I wanted to mention one thing additionally about the renovation. Before a client purchases this home, we are going to make sure that although the renovation was completed in 2019, things could have changed, right? Residents been living in the home for, over a year now, right? We go in and we inspect this home to make sure that the standard of a JWB renovation is upheld on every property that we sell. So not only was the home renovated in 2019 and had a substantial amount of work done to it to make it look as nice as it does, at the same time, we take that same mentality today. Before we are going to sell this home, there's an inspection that's done by our team to ensure that there is no deferred maintenance. There's no additional renovation work that hasn't been done to maintain the level of standard that we always sell our renovated homes or our new construction homes with. So moving on to lease renewals. So I guess your question is really spot on, Pablo. So you're saying, Greg, when you guys sell a house to a client, generally there's a new lease that's put in, right? This is different. There's a lease that's already been in place since 2019, right? And that lease will end in 2022. If I take from today till 2022, you probably have, a year and a half left on this lease. That's less than a 2 or 3 year runway. Why does it still make sense for a client to actually purchase this home? Would a client be getting a less advantageous, property by doing this? And the answer is no. So a lot of this comes down to a couple of things, right? A lot of this comes down to our ability to renew leases, right? When you're buying a rental property, being able to cash flow positive from day one is an incredible advantage for you, right? It totally beats what other turnkey companies are able to do, because many times they'll ask you to put your money down to wait for the property to be renovated, to close on the house when it's renovated, and then wait a few months to actually get a resident in place. So if you're comparing this to the normal way to actually purchase a rental property, having a resident in place and cash flow positive from day one is definitely worth it. But if we weren't very good at renewing leases, then I could totally see how somebody would say, well, this might not be an advantageous property to purchase, right? If there's going to be a property turn in, 6 months or a year and a half, are you setting me up, Greg, for having more maintenance and vacancy costs would probably be going on in somebody's mind. But the reality is we focus as hard on lease renewals as we do for signing new leases. Lease renewals last year, we set a company record. We renewed 71% of leases that came up for renewal, which is incredible. Generally, we're somewhere around 65 to 70%. So last year, in a COVID year where everybody was going crazy as far as trying to understand what their own personal finances were, and our residents were definitely in that boat, 71% of residents who came up for a renewal said, hey, I want to sign back on. And that's after living in a home for longer, signing up on a 2 or a 3 year lease right off the bat. So our ability to renew leases is incredible. Chances are that we're going to be able to renew this lease. And when you renew a lease, you save an incredible amount of money for a client that goes right to their bottom line. All right. I often talk about lease renewals as something that clients simply they don't get fired up enough about. They really should. Like, it's not something they think about, but as a property manager, if I can renew your lease, it's probably the single greatest thing I can do to affect your return on investment, like hands down, right? Because when I renew your lease, I'm saving over $5,000 for you of money that you would have had to spend when the lease came up, right? And breaking that down, you've got generally about a couple of months of lost rent that you would have incurred. From the time that it takes to get the property back, perform some work, and then get the home marketed, rented, and then moved in, it's generally about 2 months. So you've got 2 months of lost rent generally. In this case, that will come out to $2,400. Then you've got to take into account the money you're going to have to put back into the property for the property turn, the maintenance work, and the repairs. That comes out to about $2,500. So right there, you're almost at $5,000 of cost. But then the next thing that you'll have to pay any property manager is your tenant placement fee to get it re-rented again, which is equal to a full month's rent. So we've just gone through there, and every time I renew a lease for a property like this one on Red Robin, that's over $6,000 actually in this case of money that is going right into the pocket of our clients. And when you do that, you overperform on returns. So lease renewals are something that we charge a very small fee for lease renewals. We do that on purpose because we want our clients to be super excited about it. We only charge $200 per year that a lease is renewed. So $200 for a 1-year renewal, $600 for a 3-year renewal. And it's meant to be this incredible opportunity for our service team and our property management team to go to our clients and say, hey, listen, we have a huge collective win here that's going to drive up your return on investment.
Love it, man. Yeah, makes a lot of sense, right? So Ken Moline, past Not Your Average Investor Show star, puts in here in the chat, we just completed our first vacancy turn, which had the property vacant for about 6 weeks, but the key benefit was a higher rent rate and our first 3-year lease, right? So like back to your core concepts there.
Absolutely. So, and we haven't talked about rental increases at the time of renewal, right? Not only do we get rent increases generally because of the way the market is right now for renting homes, when a resident moves out, in our leases, we're actually building rental increases in while people are renewing leases as well. And that's not normal, right? Normally property management companies, if they can sign renewals, they're not getting increases at the time of renewal or in the second year of renewal. So hats off to our property management team. I did want to bring one other thing up for some of the folks who may be thinking through kind of what I'm sharing here is why this might be a win. One question you might be hearing is, okay, Greg, 71% of residents gets renewed. I have a good chance of that happening. But let's say that it doesn't happen. Am I at a disadvantage then if I'm one of the 29% of residents that doesn't get renewed here? Would I be facing seeing a higher, would I be setting myself up for lower returns on investment? And You really wouldn't be in this property. That's why I picked it here for the property of the week. Again, we talked about how it's a much higher chance of this working out the way that I mentioned, and the value of positive cash flow from day one. But this client actually is also getting a rent credit at closing. And this is something else that really, I guess, sets you up to have such a higher return on investment for you on this property. A rent credit is JWB taking this asset, selling it to you, which is already positive cash flowing day one, already, as I detailed, setting you up to have a better return on investment really than when we put it on our evaluations. But that rent credit is us then also paying you $2,400 at close to be able to buy this property and walk in with that additional bump in income right off the bat. So that's substantial. Okay. Now, Pablo, why do we do that?
I mean, I only have to assume that it's because of your core belief of under promising and over delivering, and you're going to set the client up to succeed long term or something like that. I don't know.
Well, what you said is very true there, but we would do that without giving rent credits as credits. You haven't, I mean, this is probably one of only, I don't know, maybe 2 or 3 properties we've highlighted here on the show that has a rent credit. So everything you said there is 100% true, but we do that without giving rent credits because that's just not possible most of the time. A rent credit comes into place when we have an opportunity to buy a property like we did here that's already rented. And there's already a great resident in place that has met our standard. And the last thing we want to do is take a great resident out of this home when we could create a really big win for everybody involved. Now, this resident actually is not paying full market rent right now. So on this home, the monthly rent that we've projected here is actually $1,200 a month. This resident right now is actually paying $1,100 a month. So this rent credit is a way for us to make a win-win-win here, right? We've got a resident, and the last thing that we would want to do or even could do is kick them out of the house, right? They have a lease in place, so that wouldn't even be possible. But even if it was, we wouldn't want to do that. So we've got to take care of the resident. We can keep them in this home. The next thing we can do is set up the client to have better returns. And so what we do is we say, okay, well, this is under rented for $100 a month. JWB says for 2 years, we're going to cover that difference for you. And we pay it to you right off the bat at closing because that's easier for everybody. So this client's going to get $2,400. That sets them up for success to be able to overperform on return. So that's the second win. And then the third win is for JWB to be able to bring on another client and sell another house. So we use a rent credit like this when we buy a property that otherwise would make a great investment that is just under rented. And that's how everybody can win.
Love it, man. We got a great question here that I think you're going to love answering. Sarah Underwood asks, this house is assigned to a low performing school. Is that a concern?
Sarah, I hope that you joined us on Tuesday as well, because we actually did a deep dive on the status of Jacksonville school districts and actually spoke with Gary Chartrand, who is a real leader in this space, former CEO of Acasa, which is $1 billion organization, and now a real champion for schools here in Jacksonville. So if you'd like to learn more about the status of the school districts, I would encourage you to go and check out the previous show. But you are 100% right, Sarah. This is in a below average school district. And what I share with clients is that when you're investing in a growth market like Jacksonville is, and you're investing in a market where you're trying to produce positive cash flow, your sweet spot, the place you want to be investing in, is in below middle income neighborhoods. Right below middle income is where you want to be, right? If you go above middle income, you're going to get to a place where maybe the house looks nicer, maybe the neighborhood's a little bit nicer, but ultimately you're not going to be performing and earning positive cash flow on day one. And you're going to be taking on a liability every single month because your expenses are going to outweigh your income. And that's not what we're about here. So you've got to focus on these below middle income neighborhoods. That's where the investments that we focus on are. Now, a very real conversation that we have with all potential clients is that when you're investing in a below middle income neighborhood, you should be expecting below average schools. And sometimes this is a shock for people because sometimes people who invest in real estate say, you know what, I'm going to invest in a neighborhood that has great schools because I believe that it's going to lead to a long-term tenant stay. And that ultimately is going to get me a better return on investment. And JWB has made it our business to accomplish the long-term better return on investment and to accomplish the long-term resident stays. And we do that in below average school districts. Below average schools are where we invest. And you can do that. You can do that. We've been doing it now for 15 years. And we do that by signing long-term leases, and we do it by serving residents at an incredible level. And we do that by re-signing residents at a rate of 71%. So you can accomplish the end goal, which is getting long-term resident stays and better returns on investment. And you don't have to be in above average school districts. You know, the reality is that there's no perfect investment out there. And I wish that our school districts were better. I really do. But there's no perfect investment out there. And school districts, being in below average school districts, is something that if this is going to be something that you see all this other value from the other profit centers and whatnot, you got to be willing to give on it.
Makes a lot of sense. And we've talked about it, in it at length on the show. Like you said, we had last Tuesday, we brought Gary on here to talk about the future of the school district. But yeah, man, when I was, it's a total different psychology if you're going to live in it versus you're just providing somebody a place to live that's going to live in that area anyways. And at the end of the day, you're looking at this dollars and cents, and you're still going to give them a great living experience, even though you can't really control the school district. So makes a lot of sense. Greg, do you know? Chad Willis asks, how was the home built? Is the home CBS, hardy plank, etc.? Do you know?
I believe it's concrete block, CBS. I didn't check before, but my team could give you all that information for sure. If you wanted to reach out and schedule a time to speak, you can go to chatwithjwb.com and we'll have all that information for you.
Is this house currently for sale, Greg? I know that some of these houses tend to move real quickly.
And they've been moving quicker than we can get on the show lately. That's just the status of things. Things are moving at an incredible pace. So this one actually was just sold to a client. And for those who are kind of unsure of how we do this show and how we come up with the properties of the week, Pablo and I prepare these, about a week ahead of time. We're looking at inventory and we're saying, okay, this would be a great one for us to highlight. And so in between that week, properties, of course, are picked up by clients. So this one is not available. It is actually under contract with a client to purchase. But I do want to let anybody know who is interested in this one. We have other ones that are extremely similar. JWB does the same thing over and over and over again with the same price points and the same neighborhoods with the same return on investment. So if this is something you're interested in, I would highly encourage you to speak with my team and we'll have something very similar for you.
There you go. So we're here to teach. But yeah, one of the big things that I've learned in being the host of this show for a year now is that this is an asset class, not a property, right? Like I don't ask the T-bill of like whether they have the left T-bill or the right T-bill across the street, right? Like as long as it is returning on that ROI, it fits into that same risk profile and whatever that is, that's what you're buying in here, which is what I have done too. So Lee Bishop writes, $165K for 5-bed, 2-bath is a lot of value for the price. This is not the normal footprint for a JWB house due to the total size of 1456 square foot. By the way, spoiler alert, Lee's been around for a while. He knows everything. The rooms may be small for a larger family. This will be a great rental. Greg, do you see a lot of larger families as tenants looking for houses to rent?
I'd say a 5-bedroom, 2-bath house is a little bit in the minority of our overall housing stock just because we build so many new homes as well. And we don't build 5-bedroom homes. We build 3-bedroom and 4-bedroom homes. So I'd say overall you have less demand for 5-bedroom homes than you do for 4-bedroom homes, but you also have a lot less supply for 5-bedroom homes than you do for 4-bedroom homes. So at the end of the day, we rent 5-bedroom homes very well. But overall, if you had to think about it, you probably have less families that need 5 bedrooms and you also have less housing supply out there, and supply and demand work in unison there. So you're in a good spot to get it rented either way.
There you go. And a little example of the wisdom of the crowd. Bill Shields in the chat puts in COJ property appraiser lists concrete blocks. So it is CBS. Zimin Gna asks, how long did it take to put it back on the market, or how long was it vacant?
Well, we bought it occupied. So there hasn't been a vacancy, but I'll give you just kind of overall numbers. Generally plan to be without rental income for about 2 months when you do have a vacancy. And kind of breaking that down, it takes generally about, let's call it about 10 days or maybe 14 days to get the property, perform a scope of work, do the work on the property to get it ready to go to market. And then it takes about 40 days for market to move in. And so that means you're marketing it for rent until the point that you get a deposit from the new resident, and then you give them some time to actually move into the house. That's about 40 days historically for us. So all in all, I just kind of totaled up about 55 days. And I tell people to expect about 2 months of lost rental income during a vacancy.
That makes sense. And that is kind of right in line with what I'm blanking out who said it, but somebody said earlier that Ken Moline. Well, Ken Moline said that he was about 6 weeks, right? So that's kind of under promising, over delivering, Greg, right there.
Mm-hmm.
Greg, when something is rented like this already, does the family have to be out for the house to be inspected?
No, the family does not have to be out. We of course coordinate with them. We're already doing their property management for them. We just simply coordinate, have one of our teammates go in and do the inspection. The same inspector who would actually be inspecting a house if we were going to purchase a house that needed work. It's the same inspector with the same criteria that we're looking at and making sure that the home is up to our JWB standard. But there's really no strain on the current resident other than, call it a half hour, an hour inspection at one time.
There you go. Mike Foster asks, are lease renewals also 2 to 3 year commitments?
Lease renewals can be 1 year, 2 year, or 3 years.
Okay. Rebecca Zern asks, and you answered a little bit of this earlier, but what incentives do you give tenants to renew? If they sign a 2 to 3 year lease, does the rent still increase annually?
Great question. So we give incentives for the residents to sign long-term leases, and we also build in rent escalators for our owners as well to continue to keep rents rising with the rate that they're rising here in Jacksonville. So if you're a resident and you come and rent with JWB, and we work through and we find out that it's going to be a great fit, then you're going to be presented with either the 2 or the 3 year option to rent. For the 2 year option, we're going to keep your rent constant for the first year. And then in the second year, your rent is going to go up $50. In the 3 year option, we're going to keep your rent constant for the first year and the second year. And your rent is going to go up in the third year, $50. So it's a great balance of continuing to get rent increases. But at the end of the day, guys, I tell people, even if I never got a rent increase, if I could keep a resident in my house and not have that additional maintenance and vacancy and tenant placement fee cost, if I could have that for 10 years and I knew that was going to happen, that would still be beneficial versus getting rent increases. Like, rent increases should really just be looked at as icing on the cake. The biggest thing is keeping a great relationship with your resident so they can stay there for a very long time.
All right. Paul Sardina asks a question. Not familiar with the market, and I know I have to do my homework, but where does this property stack up for the neighborhood at $113 per square foot? And please remind me again on the average annual appreciation percentage.
Absolutely. So I'll take the appreciation first. So the way to evaluate home price appreciation is to look historically how your market has performed in the long run. Because real estate, many of you have heard real estate cycles, right? Real estate is cyclical. What that means is that history repeats itself, and it's that way with home price appreciation. So you should be looking this up. If you're investing in a market, you should go back and look as to how your market has performed over the last 30 years. And that's going to be a great indication for you of how your market will perform for the next 10, 20 year segment of time. In Jacksonville, historically, since 1991, we've appreciated at a rate of 4.3% per year. And so you can use this information to say, okay, if you are going to invest for a full market cycle, there's a high degree of probability that your average appreciation rate per year is going to be somewhere around that 4.3%. And that's for Jacksonville overall. So this property is in the west side of Jacksonville. It's one of our 4 neighborhoods. And all of our properties are sold at market value. So $165,000 is supported by other sales in the area that are happening right now. And then 1,456 square feet is pretty normal for a property in the west side there for this neighborhood here where Red Robin is. So I believe you said it was $113 per square foot, right in line with other homes that are selling right now.
There you go. And Greg, I went ahead and inputted the 4.3% home price appreciation, right? Like I know that these return sheets come with 0% appreciation because you can't control them holding on for a full market cycle. But I can't help but notice that when I put in 4.3%, the ROI goes from 10%, 10.05 to 25.68%. I thought you could use that as a teaching moment to talk about what's going on there.
That's a great segue. Absolutely. So what we're seeing here is if you are that investor that's investing for a full market cycle, this is the way you should be evaluating this asset compared to your other choices in other markets that you would be investing in, because not all real estate markets are created the same, especially when it comes to long-term home price appreciation rates. So when you put 4.3% in there, which is what Jacksonville performs at, you're going to see a huge jump to your total return on investment. And this is due to leverage. I'm a big proponent. I very much believe that long-term wealth creation is largely tied to how well you can manage and understand and take advantage of other people's money. And so here, what you're showing is that as your appreciation rate on this property each year goes up 4.3%, you're seeing a much bigger jump to your return on investment than 4.3%. That's the beauty of leverage, because what happens is your market value, let's say, goes up 4%, but your down payment was only a fraction of the full market value when you bought it. You're using other people's money. And the beauty of buying rental properties, which have shown to go up over time when you do give it a full market cycle, is that these two things work perfectly. Your market value goes up 4%, but in this case, if you're only putting 25% down, your return on investment is a lot more than 4%. And you guys can do this at home. If you got a phone calculator here, go ahead and put $4,000, put 4,000 over 25,000. That would be assuming that you had a market value of $100,000 for this property and it went up 4%. That's a $4,000 gain. So say 4,000 divided by 25,000. That would be assuming that you put 25% down on that property, and that would be that $25,000 initial investment. 4,000 divided by 25,000 is 16%. And what that's showing you is that your return on investment, specifically from home price appreciation, is 16%. When the value goes up 4% and you only put 25% down, you're actually earning a 16% return on investment. And that's why it largely jumps up about 16% there, from about 10 to 26%.
Boom. Great explanation. Jonathan Brown puts in the chat here, gotta love Oregon, cost per square foot, $225 to $300. Listen, man, I get it. I was living in Miami before I came to Jacksonville, and then I realized that, not all markets are made equal, and it's better to play at the $5 blackjack table than the $500 blackjack table, even if you can count cards.
I like that.
Right. Now that we're talking about down payments, I saw there was somebody in the chat put in, what is the typical down payment for homes like this? You want to go over that, Greg? And maybe I can go into the conventional financing analysis.
Yeah, that'd be a great thing to do. And just for everybody's knowledge and use here, this spreadsheet that we're looking at, that we are putting numbers in here, is available for everybody. If you want the same exact spreadsheet so you can compare your real estate investment decisions across markets or across other properties within the same market, you can get this. We offer this for free. You can go to jwbpassiveguide.com and you can follow along at home for sure. But with this spreadsheet, we're going to make it very easy for you to be able to put your own numbers in here when it comes to financing. And so, Pablo, if you zoom in a little bit, I know it gets a little bit crazy with all these numbers when we're at this conventional financing tab, but zoom in there and just show kind of like, yeah, right there, the financing assumptions. Perfect, man. So you're going to be able to put down as little as 20% when it comes to buying a property. We put 25% right off the bat. Pablo, why do we put 25% if people can put 20%?
I blanked out. Tell me.
Nice, man. I always put that as a feather in my cap when I can stump you there. We put 25% because it goes along with our core values that we want to under promise and over deliver. Like, I care so much about showing you that you're going to earn a certain return on investment, and then showing up. My team cares so much about showing up 1 year, 5 years, 10 years later, and that we did better. And so there are so many companies out here that sell rental properties that when you put, if you put 20% down versus 25% down, that's going to bump up your expected return on investment and just gives them less of a chance to under promise and over deliver. So Pablo, if you would, let's go back and there we go. Let's get rid of the appreciation. Let's keep it, what our
We're
standard.
like one brain, Greg. I'm all over it.
So good. All right. So you can see here what Pablo did is we're at 25% down right here. This is the standard. And you guys see on the right-hand side, total ROI from all profit centers, not including home price appreciation, is 10.05%. Pablo, would you go and change that from 25% down to 20%?
I will, as I defend myself from Bill Shields in the chat saying that I have the right answers just to the wrong questions. I see you, Bill.
So this is what other, real estate agents, rental property investment companies will do. If you look at their evaluations, they'll go the absolute best way that they could potentially produce a return on investment. And for here, if you put 20% down, that same property that I just showed you earlier and got you excited about at a 10% return jumps into an 11.39% return. And many companies feel like they need to do this in order to, Pablo, what are you doing, bro?
I don't know what I'm doing, man. I'm trying to respond to Bill here in the chat, and I just keep trying to type in the chat, but I'm typing in the sheet. I'm an idiot. I don't know what to do.
You're crazy, man. Crazy.
I'm crazy.
So this is a good example. Be aware of this so you can compare apples to apples and make the best decision for you. So 20% is what you can put down. Generally speaking, you're going to find a higher return on investment the lower amount that you put down. You may see a bump in the interest rate. It might be slightly higher. It will be slightly higher most of the time if you put 20% down versus 25%. But when you include all of that, you include that slightly higher interest rate, but you put less down, your overall return on investment is actually higher, taking all of that into account most of the time when it comes to and that's why a lot of investors will actually put down 20%, even though our evaluations say 25.
By the way, let's do that exercise. I got 3.61%, right? So do that, and it goes up another couple bumps.
Yeah,
right? So,
exactly. That's our other under promise and over deliver moment there. Your specific interest rate will largely be determined by your conversations with the lender that we put you in touch with. And 4% is something that we know you can get. And, it is possible, as Pablo just showed there, to get lower than 4% because Pablo literally just did it. So
literally, true story. Apart from break the sheet all the time. All right, here we go. A couple more questions. Rebecca Zern asks, is the lease up fee $1,200 or the $200 per year renewal fee in addition to the JWB property management fee? In other words, 10% for one property.
Yes, absolutely. It is in addition to it. There's three buckets of fees for most property management companies. One will be your monthly management fee, which is generally around 10% of the gross rents that are collected. Another fee is your tenant placement fee, which is also known as a lease up fee. And generally that's about a month's rent. That's what it is for JWB. And then the third bucket is your lease renewal fees. And those go all over the board. JWBs are really inexpensive. It's $200 for every year that is renewed. And we renew 1, 2, and 3 year leases.
There you go. Easy peasy. Roger Evans asks, playing devil's advocate, what would entice this renter to re-sign if their rent increased by $1,200 a year?
What would entice this resident? Every resident's going to make the best decision that produces the most value for them, right? So when this resident looks around at their options, they're going to look at their home and they're going to compare it to what they could rent the home down the street for. That happens every single time. So the decision would be based on value, as it always is. I will tell you, though, that nobody likes to move. And, if we can just treat our residents like gold and not give them a reason to leave, knowing that we have molded them and conditioned them in the beginning to expect long-term resident stays, which is the way it is, then it's you are fighting. You're in a great spot, right? If you are not giving people a reason to want to leave, people hate to move. And if you're creating enough value, that's at the end of the day why 71% of our residents renew. So you gotta make sure that it's working on all angles there. But we're starting from a position of strength, let's say, because people hate moving, and we make sure to remind people how much moving sucks.
Yeah, I don't know if people here in the chat have moved recently, right? But like I moved 3 years ago and it's the worst. Like it's really, really terrible. And then I've seen on the other side of the equation, I have seen the above and beyond, right? Like being on this side of the camera when we're talking about during COVID and all the things that you do to lead with compassion and the way that you treat your residents. Number one, calling them residents and not tenants, right? Like I think that's a good mindset shift right there. And then again, end of the year, I don't know if you guys saw this. I know Gregg isn't going to toot his own horn, but JWB went out and they gave $1,000 to 100 families like that over the holidays, right? Like I don't think any property management company does that. So I've seen it firsthand on the long-term relationship driven way that you do business, not just with your clients, but also with your clients' clients who are the residents. And I think it makes perfect sense to not want to move.
Thank you, brother. I mean, it comes from an understanding and a reality that nothing works in this investment model unless you have happy residents, because it all starts with rental income. And so most property management companies do not feel that way because they're going to collect rent no matter what. Their job is not to produce a return on investment for you, right? In fact, if they turn the resident over, meaning that they do not renew the resident, a property management company actually makes more money when they do that, right? Because as I just shared with you, tenant placement fees bring in more money for a property management company than lease renewals do. So property management companies do not have the incentive to focus on making residents happy and staying long-term as much as a turnkey rental property company does. And a turnkey rental property company like JWB is here to deliver a return on investment. I share with people that there are a lot of ways to keep your house rented and totally fail on the return on investment calculation, right? So, I mean, at the core of everything you just mentioned there, it's because we know that we have to have really happy residents or else this model doesn't work.
Makes perfect sense, man. We got 3 quick hitter questions. And, right now people are putting questions in the chat. The chat's not moving super fast, so I'm able to track it. But if you really want to make sure that I can track it, put it in the Q&A, please. I would really appreciate that. Or else I'm going to break the sheet again, I swear. All right. Sarah Underwood asks, can I use my own lender/loan broker?
It's a great question. The answer, unfortunately, is no, Sarah. The reason that we put you in our network of approved lenders is for your benefit, and it's also for JWB's benefit. Because quite simply, we know enough to know that, it's like the wild, wild west when it comes to loan officers and mortgage brokers out there. And there are many that are wonderful, but there are many that have not closed a loan in Florida for a rental property. And there's additional rules and requirements many times that they don't even know are there. And we're not going to risk putting you in a situation where you go through 6 weeks or 8 weeks of a loan closing, you put all your documents together, you go through that, only to find out that the loan was never possible to be done. And that is a real thing for many rental property investors, especially if they're not in Jacksonville, if they're not in that market. And then on the other hand, we do this to protect JWB too, because, at the end of the day, JWB keeps the lights on by selling houses. That's the reality. That's a good thing because you know how we're motivated, right? We're here to produce a return on investment so that we can sell houses, right? And well over 60% of our clients use conventional financing when they purchase homes. So that means on a 60%, if over 60% of our sales every single month, we're really in the hands of a mortgage broker or a loan officer that we had no relationship with, that we had no understanding if they could actually perform. That would put a lot of people at risk here. It would put our clients at risk, put residents at risk, put our team at risk. And that's not a risk that most turnkey companies are going to take. So what we do is we have an incredible group of approved lenders in our network Their rates are the best. We make sure we vet them for costs and fees and terms to make sure we're putting you in a great spot. We do not collect any kickbacks or referral fees from any lender in our network. We simply want them to give you the best rate, and we want them to close the loan for you. So that's how we operate it.
There you go. And I know I would have been real bummed if after all this approval stuff, like, man, I found like a lien from like 2004. I had no idea existed, right? Like all the obstacles that you got to do to close on this thing and then have the lender not come through would have been a real bummer. So I'm glad that I used, was it Parkham? Those guys were great. So, All right, Josh, the Zoom man, Stanley. Josh, you officially got a Not Your Average Investor Show nickname. You're welcome. Asks, is the $1,440 property management paid upfront or proportionately taken from each monthly rent payment, 10%? What if the tenant does not pay? Is it still charged?
Josh, great questions. That's not something that I've actually taken the time to share how that gets paid, maybe even on the show ever. So thank you so much for that question. So when you're buying your rental property and the management comes with it, you want your property manager to be incentivized to collect rent for you. And you want the goals to be aligned. One of the goals that definitely should be aligned is that they're only earning a monthly management fee when the rents are collected and as the rents are collected. So one of your questions there was, does JWB earn a fee even if the house is vacant? And the answer is no. And when you're out there vetting other property management companies, I would hold firm on that as being non-negotiable. It makes no sense to me that a property management company would earn a monthly management fee if they're not collecting rent for you. But that is how some property management companies operate out there. So no, JWB only earns our monthly management fee when we're collecting rent for you. And that's 10% of the rents that we collect. And then you had asked about that $1,440. Is that collected day one upfront? No, that would be, in this case, the rent is $1,200 a month. So JWB would earn $120 each month that we're collecting rent for the full 12 months. And at the end of the year, the total amount that we would have earned would have been $1,440, I believe.
There you go. Easy peasy. Nadeem Shah asks, does your approved lenders finance other markets too, or just the Jacksonville market?
Yes, many do finance properties in other markets.
There you go. Yeah, the guys that I used were out of Texas, so I'm sure they finance other markets, right?
Mm-hmm.
And we have one more that I saw in the chat, and then we're done here, man. Kathy Mahoney. Welcome, Kathy. By the way, Josh Stanley, not many people get a nickname on the Not Your Average Investor Show, especially first-timers, buddy. So, you got an extraordinary story. I hope you come back. Kathy Mahoney asks, how are you handling the moratorium where tenants can stop paying / defer rent?
Yeah, Kathy, that's been a really important topic to talk about for this entire year, and it's unfortunately not going away. We don't know how long the moratorium is still going to be in place, and whatever your viewpoints are on it, it creates a challenge for property management companies. We're actually going to do a much deeper dive on this, Kathy, when we do our real estate market update. That's coming up in 2 weeks. That is the 16th of... Did I get that right? Yeah, the 16th of February. So I would highly encourage you to come back for the show in 2 Tuesdays. We're going to talk a lot about rent collection. We're going to give updates on the moratorium and whatnot. Would love for you to be here. The reality is that whether or not there's been a moratorium really scared a lot of investors out there as to whether or not you're going to collect rent. But there has been incredibly positive news, both from JWB's data of rent collection, as well as other really key operators in this space that I know and talk to. And this asset class overall has performed very well when it comes to consistently performing returns. Actually, returns have gone way up in this asset class as homes have appreciated. And it's been consistent, right? If you compare what happened in the stock market, even before we started the show talking about the market manipulation of the GameStop thing that's going on and the volatility. Well, when COVID broke, the market dropped 26% in 4 trading days. And then since came back and has rallied, but all of that is volatility. In rental properties, even though we had a moratorium and have had a moratorium where we could not evict residents for a long period of time, we couldn't even file evictions for residents for a long period of time, people still want to keep their house. And we made sure that we invested in our relationships with our residents and also share with them the reality that at some point, there's not going to be a moratorium. So you can't just kind of, we're going to work with you to help you, but it's not something that you can just kind of like, it's not forgiven. Rent isn't forgiven. And so people fully understood that if there is a way that they can pay rent, that it's to their best benefit to do it. At the end of the day, we totaled up our rent collection numbers and we collected 98% of rents in 2020, which is incredible. And if you compare it to our historical averages, we're at about 98.5%. So we were down about 0.5% of rent collection. So you want to talk about an asset class that provides stability, even in a COVID time when the world was on its head. Rental properties is what it's been. To give you just a little bit of an update on where we stand right now, there's actually there is more of an ability to move the eviction process along, while there also is this moratorium right now. So now in Duval County, you can actually file the eviction process. You can start the process. And there are certain things that residents need to do to prove that there is a financial hardship due to COVID. And, that can be effectively challenged sometimes. So for us, we start the evictions like we normally have at this point. They're not coming through at the rate that we would expect because there is this moratorium right now. And we're very sensitive to this situation. We want to make sure we can help residents as much as possible, but there's more traction now. And ultimately for me, what that does is it gives me better insight into what our eviction percentages would be in a normal year, because now everybody, if there is a payment issue, the normal process for everything minus actually going through with the eviction is going on according to the normal procedure. So we have better data. But even when we didn't, we had an incredibly high rate of rent collection. I'm really proud to perform for clients in a time when people were really looking for stability and consistency. This asset class and our team has been able to do that.
Heck of a call again today, Gregg. We had about 50 people on with us today. Thursday it's our favorite day, right? Like this is what feels like friends and family day, because this does feel like our little group of friends here. And it's been really, really wonderful. We don't take for granted the idea that you take an hour out of your day to spend it with us and ask us questions and let Gregg answer them and let me mess around with the Excel sheet that I keep breaking all the time. But, this has been really, really awesome. Next week, Gregg's been working real hard on this thing, right? In our morning runs, we've been talking real heavily about market cycles and what part of the cycle we're in right now and what you can learn from the pattern recognition that comes from somebody who A, has been in the game for 14 years and lived the last cycle, and B, is kind of nerdy about the cycles and the stats and all this type of stuff, right? So I know Gregg's been like really diving into it. He's got something to show you next week. We're going to talk about what stage of the cycle we're in on Tuesday, 12:30 Eastern. I hope you join us. Hope you come back. And Gregg, if you want to download the sheet that I was breaking earlier today, go to jwbpassiveguide.com. You can download it there and get the passive guide and toolkit. And that's it. I just really appreciate being a part of the Thursday calls. Gregg, I'll leave it up to you to say goodbye.
Likewise, bro. This is always fun. Thank you everybody for being here. Especially want to recognize the new faces and the new names here. Really welcome you to the community. Thank you guys for making this so fun, and would love to see you in the group. The group has continued to grow, and when there's questions that I can't answer on the show for time or whatever reason, the group is really creating incredible value by answering those questions as well. And I'm in there every day. So I would encourage you to go to the group, jwbfacebookgroup.com. And Nadeem, I saw your comment and said that you're having troubles getting into the group. My team will reach out to you and we'll make sure we get you in the group. No doubt on that. So thank you all. Looking very much forward to Tuesday, really breaking down which phase of the market cycle we're in. So we are going to have a great show, and I hope everybody has a great weekend. Take care, everybody.